Hey guys, John from Gutenberg Research here. In this video, I'm going to help you prep for this week's Amazon release with our Amazon earnings model. And in this demonstration, I will be using the guidance that management provided on the last conference call. So if you download the press release from the investor relations page and scroll down to page 3, you can see there's not a whole lot of guidance, so there's no need to toggle back and forth between the earnings model and this page. So basically, for the fourth quarter of 2016, they're estimating sales will be between 42 billion and 46.5 billion, and operating margin is expected to be between 0 and 1.25 billion. So now I'm going to go to our earnings model, which you can download on our website, gutenbergresearch.com. If you just go to the Amazon model page and click this icon, it'll download here. And I've already got it queued up, so I'm going to go here. And you can see that I've put management's guidance in these comments here. So this is the revenue line and this is the operating margin line. So again, management guided to between 42 and 45.5 billion. So right now we've got it just below the high end of that range at 44.67 billion, and that's in line with the consensus estimates as indicated by the orange cells. And while we're here, you can see that I've calibrated this model to meet the consensus revenue estimates for the next 12 months. So that's for the December quarter through the September quarter of next year. And I've also calibrated the model to meet the midpoint of management's guided range for operating margin. So that's between 0 and 1.25 billion. So I have it here at 625 million. So let me show you how I got to these results here. Just really quick, the model follows the same format as our other models. The top section is the income statement, and the dark gray columns represent the historic actual results, whereas the light gray columns represent my estimates for the future forecast periods. Below the income statement is the segment details, and this is where I put all my main assumptions, which feed up to the income statement up above with equations. So you can see the key cells that I put estimates in are these blue cells. So for example, for the North America segment, I have estimates for quarter-over-quarter growth rates, which drive the total North America sales estimate, and I just allocate back to the individual breakdown between media sales, electronic and merchandise sales, and other sales based on the same breakdown that we saw in the previous quarter. And then I also put an estimate in for operating margin for each of the segments. So you can see that's how I get back to the operating income or loss for each of these. So this is North America, which is based on my revenue estimate, and the operating margin. So below we've got international segment, and then we have Amazon Web Services. And then even though Amazon doesn't report non-GAAP EPS, I do put the estimates in for stock-based compensation and amortization of intangibles. So if you'd like to view this on a non-GAAP basis, you can. And they do give historic breakouts between these categories: cost of goods sold, fulfillment costs, marketing, technology and content, and general and administrative. So they're basically giving you all the details that you need for non-GAAP items. They also give some details on intangible amortization, which is typically included in non-GAAP adjustments. What I do is I just take stock-based compensation and I strip that out of the results up in the income statement. And then I also put in an assumption for effective tax rate on stock-based comp. I leave the amortization of intangibles out of the estimate because it's mixed in with other operating expense, and it kind of gets a little bit dicey there, especially because the company doesn't report on non-GAAP, so it's kind of hard to allocate that out. It's not really a significant driver of what would be non-GAAP adjustments anyway, so I don't think it's really all that important. Below the non-GAAP items, we have some ratio analysis, and this is basically used to finish out the rest of the income statement. And I have some assumptions for changes in share count. And that is essentially it. And then the valuation for Amazon is a little bit different. The focus tends to be on operating margin and sales. So that's how I've reflected this here. I've changed this from a price earnings based valuation to a price to operating margin per share. And that's on a non-GAAP basis after we strip out the after-tax impact of stock-based compensation. And it's also on an ex-cash basis too. So you can see that I value cash separately. So right now I have this at 42 times the next 12-month estimate of operating profit per share, ex-cash of 20, just over $20 or just under $21. And that's where shares are trading right now. So I've just calibrated this to meet, heading into this release, meet the valuation that we're seeing at about $835 per share. And the reason I've done that is that once the results come out, we can update the December quarter and then update the next quarter for management's guidance and instantly see what the impact is on share price to see if the price move in after hours makes sense or not. So let's take a look at the segment assumptions that I put in here. So what I tried to do is I'm trying to paint a picture of stable revenue growth for each of the segments, similar to what we've seen in the comparable quarters of the previous year, but growing into the recent investments that they made in content and fulfillment centers and data centers. So that investment has been pretty strong over the last couple of quarters. And I'm thinking that if that slows down just a bit, they can grow into their current investments and increase their utilization of their new assets, especially the fulfillment centers, and that should have a beneficial impact on operating margins. So for North America, starting with revenue, if we look at last fourth quarter, so revenue grew at 43.3% quarter over quarter in the December quarter of 2015. So I have that down just a bit at 41.3. And then for the March quarter of next year, I'm expecting just over 22% decline, whereas they saw 21% in the first quarter of last year. And then 3% versus 4%, 6% versus 6.8%, 40% versus 41.3%. So you can see I'm basically in line with what we saw over the 2016 year. And then for operating margin, I have this coming down in the December quarter. So we're basically recognizing the fact that management will probably just finish up with some additional fulfillment center costs in the fourth quarter. But this is really to get back to the midpoint of management's guided range. So if they hit the high end of the target at 1.25 billion operating margin, then chances are the North America operating margin would be much greater. So that's kind of the variability there. And if you want to, you can download this model and plug in your own estimates. So if you think that the operating margin is going to be similar to the December quarter of last year, you can just plug in 4.7% here, scroll up and see even then you're still within management's guided range and the price target has increased. So I'm going to undo that. So again, in this consensus-based model, I try to keep things at the midpoint of management's guidance and at the consensus estimates. So that's why I've calibrated the way I have. Then after the December quarter, I have margins, still below what we saw in the first half of 2016, but then sort of peaking out towards the back half of 2017. So you can see I had this stable at 6.5%, which is what we saw in the June quarter of last year. And then we saw 3.7% last quarter. And I've got that up 30 basis points to 4%. So again, growing into those investments and then reaching 4.5% in the December 2017 quarter. And I have it basically following similar trends in the international segment, reaching break even somewhere in the first quarter of 2017. And then again, increasing through the back half of 2017. For Amazon Web Services, this one is still kind of fluctuating. I'm not really sure where to put the operating margin. I just kept it consistent at about the average of the last two quarters. So I'm just keeping it consistent at 30%. And I'm keeping the revenue growth rates in line with estimates from last year. So that's it. So when I put those items in, I get to a total operating margin per share of $19.32. And again, with that high price to operating margin multiple of 42 times, we get to $835. So definitely check back after the release. I'll update this and post it on the website. Probably not going to do a video for this one after the release this week, but I will put the updates online. Thanks for watching and good luck with the rest of earnings season.